How Do I Buy Cheap Stocks? By www.profitableinvestingtips.com. The old adage for successful stock investing is to buy low and sell high. But how do you buy cheap stocks? Where do you find them, and how do you pick the most profitable ones? A couple of weeks ago, we asked the question, what is value investing? Value investing should always be on your mind when searching for cheap stocks. The simple approach to value investing is to use a stock screening tool like the one in Google Finance to find stocks with low price-to-earnings ratios, PE ratio, or price-to-book ratios, and high dividends. In short, what you are looking for are stocks that are cheap in relation to their current market price. That is the focal point of intrinsic value analysis. Cheap price, high intrinsic value. How to buy cheap stocks is to use a stock screener. A basic one can be found on Google Finance. Pick a high PE ratio and look for stocks that have lost market price in the last year. It may be useful to do a few separate stock screens for high cap, mid cap, and low cap stocks. Make a list of the stocks, their prices, and PE ratios. Stocks that have fallen in price in the last year and have higher PE ratios should be high on your list when you buy cheap stocks. Once you have a couple of lists, you will want to look at intrinsic stock value. The key to determining intrinsic value of a stock is getting a clear idea of the medium and long-term prospects of the business in question. Successful stock investors learn to judge how well a company will manage its assets, products, costs, R&D, and marketing. When the picture is clear, an investor can make an informed decision. If the market price is less than the intrinsic value of a stock, it is time to buy, and if one owns the stock and the prices are reversed, it is time to sell. Here is the original formula from Benjamin Graham. Preceding 12 months earnings per share, EPS, a constant of 8.5 representing an expected price-to-earnings ratio, PE ratio, for a company that is not growing, G being an estimate of long-term growth, 5 years. A constant equal 4.4, the average yield of high-grade corporate bonds in the early 1960 decade. Y equal the current yield of AAA corporate bonds. V equal intrinsic value. The formula is as follows. V equal EPS times 8.5 plus 2G times 4.4 over Y. Divide V by the current market price to get the relative Graham value, RGV. If the RGV is greater than 1, the stock price is cheap in relation to its expected earnings, and if the RGV is less than 1, the stock is overpriced in regard to its forward-looking earnings. What if I just buy cheap stocks? What if I just buy low-price stocks? The efficient market hypothesis says that all stocks are priced fairly according to what is currently known about the stock. As such, this theory says that there are no cheap stocks in relation to market value. A rule of thumb is that a randomly chosen basket of low-cap stocks should include 40 stocks. For more about this approach, read the book A Random Walk Down Wall Street, which reports that a group of stocks chosen by throwing darts at the Wall Street Journal New York Stock Exchange stock listing provided a better group of winners than most fund managers. For more insights and useful information about investing and investments, visit www.profitableinvestingtips.com.